Hello and welcome to today's mid-quarter update. With us today, we have Jay Sanford, Justin Fisk, and Chris Karam, members of the Hub investment team, who are joining us to give us an update on the market activity partway through the first quarter of 2021. Justin, I'll let you take it from here.
Thanks, Sarah. In this update, we have the latest GDP figures, data on COVID and vaccinations in the US, year-to-date asset class returns, and thoughts on the changing interest rate environment. To get us started, this graph shows growth in real GDP along with total GDP by quarter. After historic moves down and up of over 30% each in the second and third quarters of 2020, quarter over quarter real GDP growth in the fourth quarter measured 4%. The Atlanta Fed's GDP Now tool estimates GDP growth of 9.5% for the first quarter of 2021. The advanced estimate of first quarter GDP growth will be released by the Bureau of Economic Analysis on April 29th. Moving on to COVID-19, this slide shows the number of daily cases of COVID reported to the CDC, along with daily count of total vaccine doses administered. The 7-day average for daily US COVID cases reported peaked at over 249,000 on January 11th and has trended down to approximately 86,000 as of February 15th. Vaccine administration has trended up since December, with the 7-day average of total doses reported exceeding 1.5 million per day, and the 7-day average of people receiving the second dose exceeding 650,000 per day as of February 12th. Jay's up next to talk about asset class returns.
Thanks, Justin. So I don't think you are going to find any surprises here in terms of the asset classes leading the charge in 2021. We have an economy coming out of recession, which historically is led by small caps. You can put a check mark there. Emerging markets are continuing their run from 2020, helped by the weaker dollar. Commodities have rebounded as well, specifically oil, as the reopening of the economy, fingers crossed, becomes closer to reality. Current weather is putting further pressure on supply, lifting oil even further. Large caps continue to show strength, but the makeup of that return is now more balanced between growth and value. We will continue to keep an eye on value to see if it has staying power in 2021. Bonds have found some softness based on rising rates. Inflation concerns and a general sigh of relief about the economy normalizing are major forces in rates rising and returns falling at the moment. Finally, asset allocation takes the middle ground yet again, proving that a diversified portfolio will give a smoother ride through the good and the bad of the markets. Digging into the small cap numbers, we see an almost unprecedented run by small caps over the last 4 or 5 months compared to large caps. And let's not forget, large caps have done really well. That said, only in the year 2000 did we see the spread between small caps and large caps be larger. Again, maybe not a surprise given we are working out of a recession, but still staggering in terms of the velocity. If we look 3 years later though, historically, it doesn't translate to a definitive bias towards small caps. So we will have to wait and see where this takes us. But for now, small caps are leading the way in 2021. Now over to Chris.
Thanks, Jay. One of the main capital market stories we're going to be watching here in 2021 has to do with interest rates and inflation. Very recently, the Federal Reserve has come out, actually on a couple occasions, come out and said that they're going to allow short-term rates alone so long as inflation ticks above its Federal Reserve target level of 2%. And because of that, we have seen yields rise substantially compared to where they were 6 months ago. On this chart, you'll see where they were as of February 11th of 2020 in the blue, where yields were 6 months ago in the green, and where yields rested on February 11th, 2021 in the yellow. Couple key indicators. First and foremost, the Federal Reserve has control over the short end or the lower left side of the yield curve, and that's anchored to close to zero and will be based on their indications for quite some time. Where you are seeing some movement, especially over the last 6 months, has been in the 10-year column and the 30-year treasuries, which have gone from 1.16 as of a week ago to 1.28% today on the 10-year, and the 30-year has risen from 1.94% to 2.07% as of today. And you can see that yellow line, especially with those medium and longer term rates, really catching up to where we were a year ago. A couple contributing factors aren't just that the fact that the Federal Reserve has indicated that they're going to allow inflation to run perhaps a little bit over their target 2% level as the economy rebuilds and regains momentum. It's also an indication that fixed income investors are not willing to pay for certain yields unless they exceed levels of inflation. Now, that competition for income is not isolated to just bond yields. So what we'll see on the next slide is that other asset classes can participate and compete for those income-oriented investors. Preferred stocks, emerging market debt, high yield bonds, real estate, for example, real estate investment trusts are all in the mix. And you can even throw in traditional equities as competitors for those yield-starved investors looking for income. And this, in connection with the yield curve, will be one of the important stories of 2021 that we'll be following in the capital markets. Sarah, back to you.
Thanks, Chris. That wraps up our mid-quarter update. For additional information and upcoming economic updates, subscribe using the link below.